Evening, everyone. Happy Wellness Wednesday. I hope everyone is doing great and hopefully you are able to catch the live and it's working and you're getting great audio. That is my hope. It is so great to be back. Today we are going to be discussing chapter 6 and what would the Rockefellers do? And if you're brand new here, welcome. We're so glad to have you as part of our Beyond the Busyness financial family. I'm Mia James, your financial wellness coach, and I am here to bring financial education to our community. And I am a insurance agent as well. I always love talking about insurance. Yay! Hey Jen, hey Errol, welcome back. Whew, I got my whole setup. We got some lighting. Everything's great. Praise God. Hallelujah and glory. All right, so let's jump in. I had to take notes this time, y'all, because chapter 6 is actually so far one of my favorite chapters. I really want to kind of get these highlights out to y'all because I know we only have a short amount of time, but it's some really great stuff in this chapter. Let me see who we got in here tonight. We got Arrow, we got Jen, Peace from the Southeast. Hey, Dorielle, welcome in, welcome in. So we are going to get started. I'm going to actually do some reading from the book, but then I'm going to break down some of these concepts. Um, and y'all know I told you I'm terrible with authors, but the author has done a wonderful job. I know it does go so fast, right, Jen? Of breaking things down. Now, we do have some slight differences of opinion, but you know what? It all comes down to one goal, which is making sure that you maximize your life insurance for your estate plan. So, the title of this chapter is Turn Small Assets into Big Ones. So, I'm starting to read on page 79. I'm using the book in Kindle. And hey, Doria, welcome. So glad to have you back. So he says most retirees live in fear of economic change as they are living off the interest from their nest eggs. Risk arises whenever the market shifts, taxes go up, interest rates change, or inflation diminishes purchasing power. So all that means is like, if you buy a candy bar, remember when we were kids, candy bars only cost 50 cents and then now they cost like $2. That is the diminishing of your purchasing power, right? The dollar doesn't stretch as far as it used to. And he says there's a much better way to retire by utilizing your life insurance death benefit while you're alive. So put a one in the chat if you knew that you can utilize your life insurance while you're alive. Most people don't even want to have this conversation because they're like, if I talk about life insurance, somebody's going to die. I'm like, yeah, no, that is not how that works. I've had life insurance for what I got it. Well, I probably had it my whole career, but like my own policy outside of work for like 6 or 7 years. And I'm still here. Nobody got hurt, nobody died. Okay, wonderful. Hi, Simone. Isn't gas is ridiculous. I remember, okay, so shout out to Jen, Black, who is Black on the platform. So Jen had me reminiscing. I was in my hometown last month and I passed by my gas station that I used to go to when I first got my first car. And it looked like a spaceship. It was like so fancy and gentrified, right? And I grew up in the hood, okay? And so I'm like, what is this? And then I looked at them gas prices. Y'all, it was bananas. Okay. Yes, very disrespectful. Anywho, moving on. He says car insurance allows you to drive your car without fear of loss. Likewise, permanent life insurance allows you to live your life, spend your money without fear of running out of money or failing to leave anything behind for your heirs. So let me know if you want to leave something behind to your heirs. No judgment if you don't, because hey, listen, some people don't. I have had people straight up tell me, like, I'm not trying to make my kids rich. I'm like, hey, to each his own. Um, and let me know if you do not want to run out of money. Because I know I don't, right? I'm trying to live and enjoy my life. He says, with whole life insurance, the death benefit is guaranteed to be in effect exactly 1 day longer than you. So if you go to see Jesus the next day, your beneficiaries can put in a claim and claim that money. And let's just say, God forbid, some people pass away really shortly after getting life insurance. Well, guess what? They haven't even hardly paid much into it, and their beneficiaries get a nice takeaway, right? Yes, that's what I like to hear, Simone. You funny, Jen. This is why y'all gotta be here live because the chat is where it's at. Y'all gotta see this chat. It's really great. So let's look at this. What happened here? Okay, boom. There we go. Click too fast. He says, the accumulation phase of your life is when you save and invest money during your working year. So all of us right now are probably in our accumulation phase. We're working, we're saving money, accumulating. So when we stop trading time for money, which is what I call the work optional lifestyle, we live off the money that we've invested. Now, some of us will continue investing even in our retirement years, right? Um, but there may come a point where we can't, right? Like maybe some people, when they get older, they have illnesses, they can't see this, that, and the other. So we just want to be in a place where we can live off our money if we have to, if we can't do anything. Then we have, after our accumulation phase, we have our distribution phase. And that's the phase where we are starting to use our money because we're no longer trading time for money. We're just pulling from our retirement accounts. Your death benefit, hear me clearly. This is on page 80 if you have the Kindle book. Your death benefit allows you to spend as much as 50% more cash flow when you get into the distribution phase of your life with certainty because you don't have to worry about outliving it. If you don't have a pension, right? And you have a 401k and the market takes a turn and you lose some of your money, that's less money that you have to draw on. This is like if you don't have other investments that are consistently growing. So there's a lot of things that you have to think about in terms of diversification, so that you have sufficient money to live off of when you retire. So we got a couple people that want to leave something behind to their family. Very good, very good. I love it. I love it. So now moving forward, let's talk about what you can do with your life insurance, right? So you can use, I did a little short live last week because I was out in the streets in New York because it was my husband's birthday and he decided that he wanted to be out in the city. And I was like, what we doing? And so I was out there in them streets, y'all. But anyway, so it was very loud and noisy on a New York City street. And so I couldn't really go deep in like I'm doing now. But I started talking about that you can use it for three things, right? A reverse mortgage, a charitable trust, or a pay down strategy. Really, my hope is that most of us here either go the charitable trust route or the pay down strategy route. Excuse me. This will actually allow you to plan to accelerate the rate at which you spend your money. Because if you're familiar with the financial planning industry, there's this thing called the safe rate of withdrawal. Anybody familiar with the safe rate of withdrawal? You might know this already if you have a financial planner or a financial advisor. But essentially, if you have a majority of your money invested in the market, the safe rate of withdrawal is 4%. Now, let's talk about this. I think I've talked about this before, but just in case you forgot. If you have, let's say you have $1 million that you've accumulated, right? Okay. Just for easy math, right? So we got $1 million, 4%. That's $40,000 a year that you're recommended to withdraw from that money so that you don't run out. Because a lot of people on average are living about 20 plus years in retirement. Let's just say 20 years. So, you know, 40,000 times 20 years, that's 800,000, right? Give or take. But we got inflation we got to think about. A lot of people don't realize we have to worry about increasing healthcare costs because in some instances, people have acquired illnesses as they get older. No problem, Jen. And it's just there's increasing costs that people don't think about. Like I had a client, I helped clients set up their own pension plans, right? And he came to me, he was like, okay, I'm ready to start my pension or turn it on, basically start collecting the distributions. So when we originally set it up 3 years ago, right? So it could accumulate. And he was like, I'm gonna retire in 3 years. Okay, cool. He came back. And so we had discussed a certain amount that he would need per month. I was like, are you sure? Because have you considered this, this, and that? No, no, it's fine, it's fine, it's fine. I'm like, okay. But again, I can tell a client what to consider, but ultimately it's their decision. Long story short, he ended up needing more, which I figured he would, because he didn't realize that he had to pay for Cobra for his health coverage until he qualified for Medicaid or Medicare. Hmm. I always forget if it's Medicaid or Medicare. One of those two. He wasn't of age. Let's just put it like that. Um, So he now had to pay an increased cost for healthcare that he did not anticipate when we first set up his pension plan. So that is very important for us to consider, unless you have one of those jobs, like thank God my husband does, where he'll get healthcare for life, even after he retires. I'm like, praise God, because that means I get healthcare for life. Whoop whoop. Okay. Um, so he says, this is still on page 80. If any of these things happen, right, and you actually run out of money, you still have options. So I don't, how many of you knew this? How many of you knew that you could actually sell your death benefit? Did anybody know that? Exactly, Simone, because my husband is a New York City worker. Praise him. Glory. Maybe that's why God brought me back to New York. Get these good benefits over here as an entrepreneur. I don't know. But I bet y'all didn't know. Some people didn't notice you can actually sell your death benefit. So if you live to be 100 or 120, or God forbid, if you have a terminal illness, you can actually sell or cash out your death benefit. Yeah. So that's important to know. And so now we're going to get into the nitty gritty of what you can do and how you can use your life insurance while you're still alive. So put in the chat, what are some ways that you already know that you can utilize your life insurance while you're alive? Yes, I'm on, because he is in that 55 age category. Woo, woo, praise him. I would have been too, but I quit. I was like, I can't do it no more. Oh, and please don't forget to like and subscribe, y'all. That really helps a lot. It really does, because I really need this message to get out to our community. Our community needs to know this information because we need to keep our assets in our community. So put in the chat, how can you use your life insurance while you are alive? Let me know if you know. Jen, I know you know some stuff, so put that in the chat. Arrow, Simone, Doriel, where you at? Okay, what specifically about the death benefit, Simone? Let me know. Let me know what your question is, and I will gladly answer it for you. And let me just make sure nobody is trying to get into the Zoom room. Okay, no, it's not. Okay. All right. Yes. Okay. All right, good. Y'all are doing great. Yes, you can borrow from your life insurance if you have a permanent policy. So remember, there's two types of life insurance. There's term and there's permanent. So yes, you can borrow if you have a permanent policy that accumulates cash value. You can use it for long-term care. Absolutely. Very good. Very good. All right. So let me talk about, so the one reason why I actually have personally got life insurance, because at the time I was not married. I didn't have children. I still don't have children, but um, do you know any lenders that will loan against your insurance policy? Mm, I'm trying to, what do you mean by that, Errol? Give me a little bit more context. So you can use it as collateral in certain situations, like for a business loan. Like in some instances, I don't know if that's what you mean. That's why I was like, give me a little more context. But I know that, for example, my business partner, she works with banks to help business owners get life insurance if they're trying to take out a substantial amount of business loans. So definitely you could do that. But if there's something else, let me know. And no, you can't borrow from term. because it's strictly the death benefit. There are some living benefits with term, but not the monetary ones. It's more around terminal illness, critical illness, or chronic illness. I love it. You say you're gonna be my beneficiary. I love it. Awesome. So so tell me more about this questionnaire. Hopefully I answered it for you, but you definitely can use it in collateral. You can use it for estate taxes, right? So instead of having to sell property to pay estate taxes, you can use your life insurance instead. You can use it for reverse mortgage, which I'm going to go into in a second. So traditionally, if you do a reverse mortgage, the house is the collateral. You can use your life insurance as the collateral so you don't have to sell the house. That's important to know too, right? So there's ways that we can avoid some of the pain that our um ancestors may have endured just because they didn't know this information, that there was not only one way to do things. So I have life insurance because I wanted long-term care. Why is long-term care important? Or what is long-term care? So, long-term care, the definition is if you can't perform 2 out of 6 activities of daily living, bathing, toileting, dressing, transferring, walking, and eating, I believe. I always forget number 6. I don't know why. Me and my memory. Then you can't do it for 90 days or more, you will be classified as needing long-term care. Now, if you don't know, the national average for long-term care is $7,000 a month. And long-term care comes in various forms. It could be in a nursing home. It could be in a extended, yes, thank you, Simone. It is eating. The It could be a nursing home. It could be assisted living. It could be adult daycare. It can be, you can have a family member or a friend come in and take care of you and you pay them. You can have a skilled nurse come to your home. You can have a CNA. There's many different ways long-term care can look. But remember, let's just say that you still have a home that you need to take care of. Let's say you have outstanding bills, but you need long-term care. So not only exactly, Jen, 7 to 10K, it does depend on your area. Not only do you have to take care of the long-term care, but you still got to pay for the rest of your life, whatever other financial obligations you may or may have. So if you have a policy with long-term care attached to it, you can have a standalone long-term care, but the death benefit is not as substantial as if you get a long-term care rider added on to your permanent policy. Okay. So that's just important to know. You can have a standalone long-term care, but the death benefits are usually smaller than if you get a traditional permanent policy with a long-term care rider. Okay. So that's another thing important to know. So you can use up to 70% of your death benefit while you're alive to take care of it. Yes. ADL, you better go ahead, Simone. I wish I could show this in the on the screen here, but I don't think Zoom lets you do that. I wish you did. Let me see. Pin message. No, I don't think that that's going to go on Zoom though, so people who are not here can see it. But essentially I'll read it out. Um Activities of daily living are bathing, dressing, eating, transferring, toileting, and continence. There we go. Continence was the one. I always forget that one. So those are ADL. So that's important for you to know. The other thing you can do is what's called a viatical settlement. So this is where you can actually sell your death benefit on a market. So I know when I was studying for one of my exams, we had to learn about viatical settlements. And you can sell your life insurance policy. And most people do this if they have a terminal illness. And you can sell it, like let's say you have 100,000 in death benefit. You can sell it for more than the cash value. So that way you can bring in some cash. Okay. So let's keep on going here because now we're gonna get down to the meat of it. Um, the other thing that you can use it for is you can actually create your own pension or an annuity using the cash value in your life insurance policy. So why would you do that? Now you don't have to use the entire cash value. Let's say you had in your policy $500,000 in cash value. You could leave some cash value in the policy, right? Just so it can maintain itself. And then let's say you took $250,000 out of your cash value. You can then put it into an annuity, which is basically a pension, and you can create guaranteed lifetime income. So you would know that you get X amount for the rest of your life. Okay. Now, here's the deal. If you have a traditional pension and you have a spouse or children, you want to make sure, hey Faith, you made it. If you have, okay, let me be really clear about this because a lot of people kind of screw over. I hate to say that. That sounds terrible, but it's true. Because I hear about this in trainings all the time. They kind of screw over their spouse because what they'll do is they'll select the highest amount they can take out on the pension. Well, if you have a surviving spouse or kids and you took the highest amount and you didn't do what's called a survivor benefit, you could get two pension payments and pass away, and then all that money that was in the pension for you is gone. Could you use that money to trade? Yeah, you absolutely can use the money to trade options. So the cool thing about these cash value life insurance policies, and if y'all want a consultation, I offer them for free. Um, I'll put my website in the chat and you can get a free consultation on life insurance or pensions or annuities, whatever you feel that relates to you. But here's the deal with the pension, y'all, because actually I need to handle this myself. If you take the highest amount and you pass away after two pension payments or one pension payment, that money goes away. There's no death benefit. But if you take control of your pension, right? Most people don't know that you don't have to activate your pension from your job. You can take what's called a lump sum and put it to your own annuity and then get the guaranteed lifetime payment, right? And then if anything is left, you have a death benefit. If you just leave it with your company, if you pass away whenever you pass away, there's no guaranteed death benefit. So there's a way you can take your pension into your own hands and still create that guaranteed lifetime income, but also have a death benefit. So that's important for you to know. Okay. Um, Now, he says on page 82, without a death benefit, you limit what you can take in cash flow. A certainty comes with your death benefit. When you die, your trust will be funded and your family will be taken care of. And that's a guarantee, right? It's no guarantee. If you don't select the right option when you select your pension, there's no guarantee your family will get anything. Yes, you can definitely control the pension instead of them. Oh, yeah, I take people pension all the time and help them get control their money and get them more money because a lot of times I do an analysis, right? So I tell them, I say, send me your pension analysis. So the pension is going to tell them if you do the maximum, this is how much you get per month. If you do survivor benefits, that's if applicable. It may not be applicable in some instances. And then if you want to take a lump sum, I take that lump sum amount and run it through my system. And 9 times out of 10, I could get them more than they get from that company. I love it. Makes me so happy when I can do that. So, another benefit. So, now we're going to go into the pay down strategies. We're going to wrap up here and I'll show you some illustrations. Um, so, another thing you can do is this is on page 83 if you're following along in the book, is that you can take principal and interest. So, in some advisors and planners, have their clients living off the interest. You don't necessarily have to do that, right? Because I have clients or they're not my clients, which is why this is happening to them. But every time they take a withdrawal, they got to pay taxes. And I'm like, there's a way that you don't have to do that. But some people are very comfortable doing what's safe, right? What they know, I should say, what they know. So, anywho, He says the number one thing to protect against and something that many people overlook is inflation. If you're living off a fixed income in your later years, that income will lose purchasing power each year as the cost of living continues to rise. And there are annuities that you can do that have inflation factors built into them. Unless your money is in a tax deferred qualified plan, the money you pull from your principal is tax free, right? So that means in a life insurance policy, you can pull the money out tax free. By taking more of the interest, you pay less in tax every year during the distribution phase. Your taxes drop year by year because even if tax rates rise, you take more and more principal, which has already been taxed, and earn less and less interest as you utilize your money. So I'm going to show you some of the math here so you can see the numbers. And I did promise y'all, well, let me just show y'all this before we go into that. I promise y'all I was going to show you like an illustration of how you can see your money growing in cash value life insurance policy. So I'm going to show you that really quick now. But this is actually starting with a child because I know some of you all are parents and maybe grandparents in here. And I want to show you like how you can start a child as early as 15 days old. And you can turn them into a millionaire by the time they retire. No, why don't I have share screen? So they changed Zoom, and for whatever reason, I can never find anything anymore once I did the update. I just don't like when they do that. Here we go. It's like, where is all my stuff? Okay. So hopefully you all can see this. Let's see, because I won't be able to see the chat for a second. So what this is this is 7% interest rate. This is a policy. This is on a child. It's $500,000 in insurance. And just FYI, in most cases, the parent has to have an equivalent amount of life insurance. They're putting in $400 a month until the child's 17. Some parents started their children at 17, 18. That way they have it until adulthood. But the earlier you start, the better. So that's $4,800 a year, right? And then as you see, as the policy value grows, so does the death benefit, right? So they're paying until the child's 17. And so then they want to take out some money for $100,000 from while the child between the ages of 18 and 21 for college, right? Like maybe they had a gap in the financial aid. So they withdraw 20 grand the first 3 years, and then they do a withdrawal of 16.8 and a loan of 3.2, right? And notice they're not paying in anything those 4 years. They're just withdrawing and taking a small loan. But mind you, the cash surrender, they still got some cash in there. Then the child graduates, they start paying in again, $400 a month. And then the child turns 30, they have a wedding, they take out 25 grand. This is a withdrawal, so they're not paying this back, right? Then they give the child 50 grand for a home down payment. See, so 23.4 in withdrawals, 26.6 in loans. Still got some cash value in there, right? Not a lot, but they've been using this. College, wedding, home. They doing it, right? They're really using this policy. Options trading. Sorry, I always forget that there's automations on here. Now they keep on going, right? The child's getting older. And they stop paying at 65. So notice they're not paying anymore. Okay, let's see what my little automations are going to do. But now look at this death benefit. Over $1 million. Look at this cash value though. $500,000 in cash value. You can do something with 500,000. Right? And they're not paying anymore. And then if you look here, by the time they're 68, if they keep on this trajectory, they got $1 million baby. That's what we call this. So any questions about this? I'm gonna have to stop the share though because I can't see the chat with that. So let me get out of here. Let's see. Oh dear. Let me find y'all again because it's not allowing me to be great. I have too many windows open and I gotta find y'all again. Okay, there we go. You said I know they do. Okay. Yeah, $1 million baby. All right. Any questions about that? So why I wanted to show you some numbers first. Um, so that's a great question, Simone. Can you get $1 million in 15 years if I begin now? Yeah, you can. You just have to put in a substantial amount. It is possible for sure. I have run illustrations on it, so I've seen it. You just got to be willing to put those dollars in there. Because what people be like, I just want to put in $50 a month, and I'd be like, okay, we not gonna go nowhere with that. I can tell you that right now. Um, yeah, you got to put in some real money. So, what the last thing I'll wrap up here, because I know Dr. Boyce is not having book club tonight, um, is these two scenarios. Oops, I didn't even go into charitable trust. But let me just really quickly break down this pay down strategy. So the first strategy he talks about is when that whole concept of buy term insurance, invest the difference. What that means is that you're technically self-insured. Yeah, you can do 400 a month. But we have to see, where it gets you to for sure. Because it depends on age, health, and the death benefit that you want. So yeah, we can definitely yeah, just book a call on my calendar and we can kind of run the numbers and see what options we have for you. You said you did. No, no, you gotta live, girl. You gotta live. You gotta have fun in Lily. Um, so have you all heard of buy term invest the difference? When you buy term and invest the difference, that means you are self-insured. So that means you got to guarantee that everything works out with your money and that you're not going to outlive it and you're not going to spend it all down, right? So what he says here, this is page 84. Basically over 25 years and after taxes, their net distribution is 2,162,581. The second distribution is where the client has whole life insurance and they have $2 million in cash value by retirement age. Now remember, if the cash value is the set up the same way, like when I showed y'all the $1 million baby, that's why I showed y'all that first. You can have $1 million in cash value and $1 million in death and $2 million in death benefit. So if you use the cash value, it does decrease that death benefit, but remember, you still have another million. So if you use 1 million and you keep 1 million as the death benefit, it's still a win-win situation. Y'all understand? So if you separate the two, 1 million is cash, 1 million is the death benefit. You use that million, right? You could spend that million down. That other million is still sitting over there as a as the benefit to your beneficiaries. If you spend down all your money, if you're self-insured, there's no death benefit. There's nothing left. So that is the pay down strategy. We already talked about reverse mortgage. The last thing is this charitable remainder trust. And this is where you donate to a charitable remainder trust. And that makes a portion of your donation tax deductible. Now he says this method doesn't have to screw over your family where they don't get anything. And he says basically what they do is that after 30 days after any child is born, that's when they get insurance on that child. So that those death benefits from the family help to replenish the trust. Tax free. Don't forget that part. So that's the important thing. If you do that, like a charitable remainder trust, that's basically to keep a portion of your estate taxes down. Essentially, that's that method. But when you're thinking about replenishing the money in the trust is based off the death benefits of the younger generations. So I know this was a lot. Again, I said this was one of my favorite chapters. There is another piece in here on with business owners. There's actually special life insurance for business owners that you can use to create retirement money as well as tax write-off for your business. Because what business owners know is that if you can't access your net worth when you need it, is really worthless. Like if you don't have a lot of things that are liquid and the opportunity strikes, it's hard for you to take advantage of that opportunity. So there's definitely ways that you can utilize life insurance to be able to seize opportunities. Like I actually helped a business owner yesterday. She was about to get a loan. We did her annual review. She realized she had this money in her life insurance policy, and she's like, "Oh, snap. I don't even have to get a loan now." So, I'm out here trying to help people make life easy. She was so happy. She was like, "Girl, you don't even understand how happy you just made me right now." So, yes, come on, Simone, come on over. It's definitely possible. We just have to fund it right. So, my loves, thank you for hanging back with me. I know we went over a little bit, but I hope that this was informative. I hope you learned something new. You got your questions answered. We'll be on chapter 7 next week. Yeah, I shouldn't have any more trips coming up. Well, none that will impact our time. I will be traveling, but we won't be impacting Wednesdays. So I look forward to seeing you all next week. Definitely come with your questions. I'm happy to answer your questions. You can book a free consultation on beyondthebusyness.com. And I am very happy to assist. So, tomorrow I'm actually going live. I'm gonna put it in the chat real quick. I'm actually going live on final expenses. Um, Hold on. Let me tell y'all because I'll be getting mad messages over here. Okay. I'm going live with Kiana High. She's a grief counselor. And we're talking about beyond a farewell. I'm sorry, y'all, I can't see. Making sense of funeral costs and planning ahead. So we're going to be talking about that. And I'm going to put the link in the chat for you to save your seat. And I also believe I'm going to try to stream it on my YouTube channel as well, but just in case, that's the link to sign up. It's tomorrow at 7 Eastern. And we're going to talk about funeral expenses because there are policies that you can get that are not super expensive, $25,000 policies. And there's also a company I work with that has a funeral concierge service. Highly recommend it. I have used it, clearly not for myself. It's real, but it is phenomenal. It helps you to manage all of the moving parts while you're grieving. Because, if you never planned a funeral, you never planned a funeral, and you can get price gouged because you're grieving. And so this service takes away all of that. So we're going to be talking about that tomorrow at 7 Eastern. All right, so stay awesome, y'all. Good night.